Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is December 11th, 2025, and we're diving into the third quarter earnings report of Oxford, the owner of well-known brands like Tommy Bahama, Lilly Pulitzer, and Johnny Was. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Oxford's latest earnings report provides a lot of insights into their current financial health and strategic direction, especially in a challenging retail environment.
Revenue and profitability overview. Let's start with the top line. Oxford reported consolidated net sales of $307 million for the third quarter of fiscal 2025, slightly down from $308 million in the same quarter last year. John, what does this tell us about their revenue performance?
While the revenue is relatively flat, it reflects the competitive and promotional retail environment Oxford is navigating. The slight dip in sales is offset by a strategic focus on direct-to-consumer channels, which saw a 3% increase. However, the GAAP loss per share of $4.28, largely due to $61 million in impairment charges, highlights the financial strain from these market conditions.
And how did they perform in terms of earnings per share?
On an adjusted basis, Oxford reported a loss per share of 92 cents, which is slightly better than the forecasted loss of 94. This indicates that despite the challenges, they managed to control costs and align their strategies effectively.
Operational efficiencies and future outlook. Moving on to operational efficiencies, Oxford's gross margin decreased to 61.0% from 63% last year. What factors contributed to this decline?
The decrease in gross margin is primarily due to increased costs from tariffs and a shift in sales mix towards more promotional events. Additionally, SG&A expenses rose to $213 million, driven by higher employment and occupancy costs, as well as expenses related to new store openings.
Looking ahead, what is Oxford's outlook for the rest of the fiscal year?
Oxford has revised its full-year sales guidance to a range of $1.47 billion to $1.49 billion, reflecting a more cautious view due to the current retail environment. They are focusing on inventory and expense management to navigate these challenges while investing in long-term growth.
Brand performance and strategic initiatives. Let's delve into the performance of Oxford's key brands. How did Tommy Bahama, Lilly Pulitzer, and Johnny Was fare this quarter?
Tommy Bahama saw a 4.4% decline in sales, reflecting the challenges in the discretionary spending segment. In contrast, Lilly Pulitzer experienced a 7.3% increase, benefiting from strong consumer demand for its unique offerings. Johnny Was, however, faced an 8.4% decline, impacted by organizational realignment and market conditions.
And what about their emerging brands?
The emerging brands segment showed robust growth with a 17.0% increase in sales, driven by strategic initiatives and new store openings. This highlights Oxford's ability to leverage its diverse brand portfolio to capture market opportunities.
Market challenges and company response. Oxford is facing several market challenges, including tariffs and increased interest expenses. How are these affecting their financials?
The tariffs have had a significant impact, costing the company between $25 million and $30 million. This, combined with a $2 million increase in interest expenses due to higher debt levels, has strained their financials. Cash flow from operations also decreased to $70 million from $104 million last year, reflecting these pressures.
Despite these challenges, Oxford continues to pay dividends. What does this signal to investors?
Oxford's decision to maintain a quarterly dividend of 69 cents per share demonstrates their commitment to returning value to shareholders, even amidst financial headwinds. It reflects confidence in their long-term strategy and financial resilience.
Key takeaways. In summary, Oxford's third quarter results reflect the challenges of a competitive retail environment, with flat sales and a focus on strategic adjustments. Despite a significant impairment charge, they managed to slightly beat EPS forecasts. John, any final thoughts on Oxford's investment prospects?
Oxford's diverse brand portfolio and strategic initiatives position them well for long-term growth, but investors should be mindful of the near-term challenges, particularly tariffs and market conditions. Their commitment to dividends is a positive sign of stability.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Oxford's performance in the comments below.